Take it away. Let's talk about Farmfolio.
Yeah, so I mean, I've kind of gone to and fro on this one, but essentially, I think we'd like to kind of give a bit of our journey into real assets when we decided to kind of turn away from the stock market towards all things real estate, let's call it, and kind of talk to the asset allocation we ended up living by and why we do that, because it matters how you allocate the assets based on what you're trying to achieve in life. Then we're going to kind of, on the backdrop of that, dive into what happened to our portfolio because of the pandemic, which is a topic that everybody's talking about right now. Why we now focus on two asset classes post-pandemic, and then kind of talk through farmland ownership as an asset class you may or may not have had exposure to. So that's the kind of the plan. We'd love to get through this in 20 minutes. Throw your questions in the chat box throughout. I'm keeping an eye on it on the left here on the second screen, so we can answer them live when we see them, or save them to the end. And we just love to actually get in a dialogue with people. And it's about education. We're not here to pitch. Feel free to buy a farmland lot from the Farmfolio company that I work for, but I'm not here for that reason. I think it's all about making sure people don't make mistakes and they understand what you go through for certain asset classes. So hopefully you'll see that today. So without further ado, I'm going to hand over to my better partner.
So, as Peter said, just kind of a little bit about our journey. We spent 20, 25 years in corporate, just grinding it out like most of you did probably at some point. I was with PwC for about a decade, just a classic management consultant, road warrior. Also ran somebody else's company for another, 8 years before I got up the gumption to say, okay, I'm going to do things differently and do it my way. And Peter's similar story, IT guy on Wall Street for 18 years. Was like, no, I'm going to work for myself and then I won't be in the rat race. But that Silicon Valley, startup scene was pretty much another rat race. And so, we just were like, at the end of that, so unsatisfied, right? Anxious, depressed, big paychecks, but not a lot of quality of life. And for both of us, it destroyed a couple marriages. So we knew something had to change to shift sort of our life satisfaction and really start living differently. And so we started investing more in California. So we started, okay, let's do this single family home thing. Met some people doing that, turnkey single family homes. We started to get these monthly checks and we're like, okay, this is pretty good. Use the Fannie Mae low down payments, kind of get in the game. Don't have to be accredited, all that sort of stuff. We thought, okay, let's an experiment. Let's just keep doing this, and the payments start getting bigger and bigger. And we're like, okay, this is good. And then we hit maybe 18, 20 months into it. And all of a sudden the payments in end up being payments out, because a lot of them were like Jacksonville, Florida, sort of Class C tenants. When it would be vacant, it would take a long time to fill it. People would steal your air conditioner, had a hurricane in Houston, so just, a pile of different things that started to happen. Roof needs replaced, and all of a sudden what seemed like, oh, this is great, we figured it out, steady cash flow, was like, okay, this is a nightmare. So we just kind of looked at this equation of like all these roofs, yes, in these little pods that were being property managed, but still we all know it's not really passive. You're managing that manager, and you've got to do it in all kinds of different places, not necessarily close to each other, right? So you've got no scale. So we were like, all right, enough of that. I mean, we had 24 single family homes clustered in Texas, Florida, and Pennsylvania. And so we were like, all right, we got to trade out of this. And we went into a couple of multifamily apartment buildings. So we thought, okay, less than 20 units, we'll start small scale, pick the St. Pete, Clearwater, Tampa metro area. It was booming. We were like, okay, let's do this. We managed it. We managed all parts of the operation. It was just our money. And we were like, this is a freaking lot of work. So it helped us shift towards more of a partnership model on execution of these kinds of deals going forward. But you know what? It was good to have lived it and to know and to determine where we added the most value as a partner and to our investors, right? So the other thing we experimented with was short-term rentals. So Disney and Mexico had a couple of, just short-term condo rentals there that were making nice, good short-term income. And then we latched onto syndications and we're like, okay, this is efficient. This truly can be passive as an LP. So we got into some multifamily value add up to like about 1,000 doors or so through syndications. We did a mobile home park, a boutique hotel, and a whole lot of farmland. And we're like, okay, we like this model. We like this syndication model. This works for us. It makes us happy. We're getting scale. And I mean, really, it took that journey of going through sort of trial and error, different structures of owning property, and also different kinds of assets for us to kind of get to a place where we're like, okay, here's where we feel most comfortable allocating our wealth and why, you know. So I mean, right now, like most people, we have a lot sitting in cash. First of all, ready to be opportunistic, and second of all, just because, you know, who knows. Stocks, you know, we're sitting there at like maybe 12% of our total assets, because it's good to have some liquidity, and too much sitting in cash is just being inflated away. We all know the government's lying to us there. So then there's the real estate, right? And this is where we found, you know, after those kind of high-powered big W-2 jobs that can also be yanked away in a heartbeat, after all this experimentation and so forth, through different types of asset classes, we're like, okay, real estate. And Peter's going to talk about specifically what in real estate we kind of zoned in on. But I mean, you can see 80-85% of our wealth we keep in real estate, because we like that we get both cash flow and appreciation, that they are real assets, real tangible things that never go to zero, really, you know. And it can just, you know, through that combination of cash flow and appreciation, it can strategically support our lifestyle, and it can be done so in a very passive fashion. And you know, everybody's got to have their Bitcoin bet and their gold safety, right? So we do have a little bit of insurance policy there for whatever the future is. But this is how we would, you know, the allocation strategy that for us we feel is the best at providing true wealth, which is, you know, I mean, really, it's like personal freedom, you know, time freedom, and financial freedom, because you need all three to feel like healthy and happy. I think, we think, he thinks whatever I think. Never. So, but that was our journey to passive income and our nirvana. And these are just, we were able to live kind of slow mad travel, and then also a lot of visiting and stuff, and checking out of farms and all sorts of cool things across the globe. But that was kind of our journey. Okay, so that's how we've come to where we are today, or 2020.
And so we spent probably 3+ years as digital nomads, lived around the world, 17 places, different continents, South America, Central America, Europe. And we ended up in Puerto Rico by the beach, and things were going pretty well. And then the pandemic hit. So we came across, we got a bit bored of the beach. I think we're marketed to our whole life that the utopian life is to live on a Caribbean beach. But actually after 10 months, it gets pretty boring. I mean, island fever is real. So this is a first world problem we're discussing right now. But I think that the lesson for us was that we still need to be active. We still need to be involved in projects and to work for companies and to do various things. And so we ended up taking a weekend in Denver, Colorado, last February the 26th in 2020. To kind of do a reconnaissance, see if we wanted to move back to the US and get more involved in our own multifamily syndications, various other stuff. And we got locked down, and it's been crazy for everybody. But basically, the question then became, as we were sat there, people's hair on fire, March, April, May, everybody not sure what to do. We started to see the portfolio start to shake a bit, to say the least. Our hospitality assets went to shit, excuse my French. Examples, we purchased a condo in Disneyland, 10 minutes from 19 theme parks in Florida. And 75 million visitors a year. We were making $1,500 a month in this condo. Everything was going great. I mean, what could go wrong? Obviously the park shut. There was a mandate in Florida that no more than 500 people could be in one single place, therefore the park slows down. We went from actually making $1,500 to covering $2,600 just to cover the mortgage, insurance, and HOAs. The Puerto Rican hotel we were building was supposed to be launched. It got stuck. Construction closed down. We still have not opened. We dodged a bullet, because if we'd opened that hotel a month before the pandemic, we would have lost everything in that syndication. We've basically been able to delay it. We've not finished construction. We're still trying to work out plans for opening over a year and a half later. So similarly, something which went pretty bad. The condo in Mexico was pre-construction. We built it. It was supposed to be given to us last March, and it got delayed finishing, and it was handed over 2 months ago. And we flipped straight out of it because they've just released 580 condos on the beach in Playa del Carmen, and nobody really is visiting in the way they were before. So, we believed that this hospitality portion of our portfolio was going to make us money. We could visit and travel and use it, a bit of personal alongside the business side and making money. And it really did go south. And I'd say you don't want to throw the baby out with the bathwater, but we're going to try and exit all of these assets over the next year or two if we can, because we've kind of been soured on the asset class when everything else has gone so well. So multifamily, incredible performance, never got below 93% rent collections. I would say that we're very good at multifamily syndications, but we've also got a bit of luck because they were value add. We chose steady Eddie locations, Austin, Texas, Cincinnati, Ohio. They're all in markets which had strong jobs, population growth, low crime, B class to B plus value add. We took underperforming buildings, and with the asset managers we raised money for, we basically renovated and brought the rents up 20-30%. It's been going gangbusters. We've never skipped a beat. I've got friends who are in Class C who have lost their shirt. They stopped paying rent. A lot of people in retail jobs, etc., can afford it. Eviction moratorium, all that stuff. So I feel fortunate that we're in the B class in steady markets. Secondly, farmland. We probably had a 3 to 4 week disruption in the matrix last March when we're delivering fruit to wholesale markets in Paris, Berlin, various places across Europe, US. And what had to happen was that normally restaurants and businesses, they all collect the produce from a wholesale market and then drive it back to the restaurants or stores and sell it. That all stopped with the pandemic, and it took about a month for all the supply chains to readjust, such that the wholesale markets closed down due to the pandemic, and then people started delivering to the end destination, the final mile, to get the fruit, vegetables, and other supplies to the restaurants and hotel and other industry. But there was big demand. It never stopped. And so what we kind of learned from this across, the mobile home park stagnated, honestly. Of all the people in the mobile home park, 12 people stopped paying, eviction moratorium, so we didn't lose our shirt, but the profit disappeared overnight. And all the crap tenants were the ones who didn't pay. So eviction moratorium didn't help the people that it mattered for. It just allowed people to have an excuse who were never going to pay anyway. So, but generally, hospitality, bad, multifamily, farmland, didn't skip a beat, apart from a bit of disruption in supply chains, which we recovered from quickly. And what we realized through this journey was actually, you've probably all seen the Maslow's hierarchy of needs, where at the bottom it's all that psychological. We all need as human beings food, water, warmth, rest, security, safety, and it goes up until you're a billionaire and your self-actualization, you're the most unhappy person on the planet because you have no purpose in life. And I won't go into the detail, but it was all about food and shelter. Our assets that provide people with food and shelter survived the pandemic and actually accelerated and improved during that pandemic. And so we've decided personally to double down on those two asset classes and focus on those two asset classes. So we're going to aim for 75% of our real estate assets in multifamily value-add syndications, continue to do what we're doing. We're aiming, 6 to 8% cash-on-cash return conservatively, and medium-term appreciation. Hopefully, doubling your money every 3, 5, 7 years, depending on the real estate cycle. And we're going to stick with really strong asset managers with a good track record who've been through both 2008 and the pandemic in B+ steady Eddie markets. And that is where we're going to keep pushing. And we would like to get to probably 4 or 5 key asset manager partners. We raise funds. We have an investor group of like 70 people. So we're bringing $2 to $4 million per deal to those assets. And we're going to continue doing that because they've just shown an ability to protect and grow your wealth and provide income along the way. And then we're going to do 25% allocation into overseas titled farmland. And these are providing between 12 and 20% average yearly returns. And the reason for this partly is because there's zero correlation to the stock market or US real estate cycles. Everybody points out, real estate isn't correlated to the stock market, and it is and it isn't. Depends on the real estate. You can't be blanket about these statements. But from our perspective, food's always going to be needed. So if you can choose farming product with demand, coconuts, limes, avocados, mangoes, just steady Eddie to the right retail and restaurant and wholesale markets, then I think you can actually just keep making money in perpetuity. Secondly, by going overseas, we're kind of taking away the slight worry, unlikely, that the $30 trillion in printing money will eventually come back and haunt us. I don't put a big credence in the US dollar not becoming the world's global currency, but there is always risk that if you've got your money all in one country, that things could go south and end badly. So really the farmland is a combination of diversification, currency overseas against the US dollar, and higher returns, but slightly high risks. And we'll talk about that in a second. So I want to kind of give a view. Our history of Farmfolio, which is the company I now work for, is that we were investing in their syndications for 5 years. And we have lost 300 Rand in really bad farmland providers who didn't know what the hell they were doing. And I'm going to explain that in a second. But as we kept realizing how to invest in farmland and what was important to be successful in this asset class, I ended up taking the path, let's divide and conquer. So Keke's now doing the multifamily. I'm doing farmland. We're focusing in on those asset classes separately so we can get kind of 2 bites of these 2 apples and become experts in those independently and together. And so I'm going to kind of give a flavor, 5 slides as to what this asset class is, why you should think about being in it, and how to do it the right way. That's my goal in the next 5 minutes. So why invest? You'll get this: hedge against inflation, portfolio diversification, build legacy wealth. In the same way that you're buying a multifamily syndication, 3, 5, 7 years, you often will end up flipping out of that at the peak of the market. In the case of farmland, you plant a tree, you wait longer for the produce to arrive, 3 to 5 years on average, depending on the crop, if it's permanent crops, and then it'll start to produce fruit, and it'll do it for 20 to 60 years. So we're not just doing this for our income, but we're going to pass this down to our kids because they will earn income from it in the future. And ultimately, it's long-term stable returns. It doesn't correlate to everything else we invest in on a general basis. How would you normally gain exposure to agriculture? Well, we'd all go to the public markets, ag stocks, ag ETFs, mutual funds, and farm REITs. And I've seen people do this, but ultimately, at the end of the day, by going down this traditional path of going to the public markets, you end up in the same place. Higher volatility, sentiment-driven swings based upon, macro and trader mentality, and ultimately, you don't control your assets. This stuff, even though it may not be completely correlated, with the boom and bust of the stock markets, it does all come up and down in tandem to some degree. More importantly, we have now worked out that the only way to really gain access to this asset class in the right way is to actually have titled farmland ownership. Own title to farmland that has mature lime, coconut, avocado, mango trees that are producing fruit being sold in the global markets. And the reason for this is because, number one, you know exactly what you're buying. I see so many people buy into, you know, these funds and you just don't know what's in it. At least if you know where your title farmland is, you know exactly where it is, what's on it, and really what it's producing and how much that fruit's being sold for. But also you control how long you profit from it. Because if you title it, it's in your name, an entity, a trust, and you decide how long those profits come to you and your pocketbook, compared to like a syndication where in some places they control what happens to that farmland. So let's kind of talk about how titled farmland looks out there. And this is my warning story. If you decide to pursue this and start researching the internet, you will always find projects, mostly international farmland outside the US, and it's in often cheap locations, and you'll meet people and you get a nice glossy brochure, and this is what they're going to tell you they're going to do. Number one, buy some land really cheap in a location, middle of nowhere, clear it, maybe install irrigation if climate requires it. Then they'll buy some seeds, create a nursery, grow some saplings, plant the saplings, maintain the trees, and wait 3 or 4 years in a permanent crop basis. And then they will harvest the fruit, build or rent a pack house to wash, sort, pack, and ship it over to a buyer. And people will tell you they can do this, and it's a 5 to 6 year journey. And what I do is I call this hope ag investing, because you're hoping that they're going to work all of this out before they lose your money. We lost 300 grand betting on glossy marketing brochures with 30-year IRRs, trusting, you know, people who recommended people. And we realized that you need a multidisciplinary team. Some people are really good at farming. They can plant and produce the farm, and they're rubbish at commercial distribution and sales. Other people are really good at commercial distribution and sales. They are terrible at farming. So you've got to find the full end-to-end team that knows how to do this in its entirety. And what we found was this company called Farmfolio, who kept doing it the right way. And the reason for this is because this is their approach. They basically reverse engineered this farmland ownership process. And what they did was they built they constructed a state-of-the-art pack house facility. In this case, it was a pack house. And what you do is the fruit arrives, for those who don't know, it gets washed, waxed, sorted, put into different cartons, put in a pallet, put in a refrigerator container, and shipped overseas. That's what the pack house does. This was for Tahiti limes. We actually raised a couple $1 million with 2.5 million for this private equity investment originally. So we're heavily into this. And then what Farmfolio did is they went out and they started selling the fruit to local, this is in Colombia, the country, South America, US and European retailers. And they started opening up and they started to send pallets of fruit from the regional growers. And so they had the pack house, they started open relationships, and then they said to regional growers in Colombia, all the farmers that have been producing fruit for multiple generations. It's an amazing agricultural country. And they said, listen, lime farmer number one, if you bring your fruit to our pack house door, we'll pay you double in cash what you'd be able to sell for in the local market. And what we do is we sort it out. 75% is export quality, goes to the US and Europe, Canada. 25% then gets pumped back to the Colombian market because it's a lower price. And the final step in this was that once we'd started to get this running, the pack house is called Valley Verde, we sell the fruit from 29 farms to Walmart, Trader Joe's, Publix, Costco, all the main retail names that you and I are aware of. When you walk into Walmart on the East Coast, look at the limes in a little bag, it's probably like, you know, 8 to 10 of them, it'll say product of Colombia. That's our product. We sell locally to Caruja, Exeter, and Olympica, which are the local Colombian supermarkets for the non-export quality. The next step was, now that we had all of this cash flow being generated for the Colombian farmers, we then went back and purchased the best farms and broke them into land ownership titles or lots. That is, we took a large farm, broke into 100 parcels, and we sold title to those parcels of land with that fruit growing on it. And what this did basically was, we had a farm that was producing income, broke it up, and really by selling it to people like you and me, you're basically participating in a pre-developed, vertically integrated agribusiness structure, end to end. We've removed all farmland risk to a high degree of that development phase, of planting, getting the trees to harvest, of working out how to sort and pack it, of working out how to sell it. That is all sorted out before you buy the land containing these mature Tahiti lime trees. And this is why I've ended up joining Farmfolio, is because once I saw the power of this and the predictability of the cash flow from this product, I decided to jump in and help them build a company. So an example farm, La Frontera, this has 103 quadras. A quadra, by the way, is kind of 0.64 of a hectare, or 1.28 acres, depending on where you're from. It has an average of 218 Tahiti lime trees that are between 0 and 3 years in age. And there's 22,542 trees on this farm. And so I own a title to a lot. 102 other people join us. We're in this farm owners association versus a homeowners association. And basically you would be receiving 103rd of the income and paying 103rd of the farm expenses. So we actually manage and grow and do farm management at scale for the entire farm. Then we split the income versus the expenses to the title owners at the end of the day. This is the best way to have the efficiency operationally of running a farm, but then not having to buy a farm at a high cost that you wouldn't be able to afford in the first place. So final kind of couple of slides, and I'm going to kind of open to questions. I compared doors to trees. In the same way that we were buying single family homes, we'd have one home, one tenant. We actually have a plot of land, but instead of a home, it has trees on it. Risks are different, governed by the HOA for the doors, farm owners association for the trees. Cash flow generated from tenants is now from the produce being sold. Common areas in an HOA or a condo building or a residential neighborhood that are managed by the HOA, like pool, gym, and clubhouse, inner roads, and all that stuff. We have common areas for harvesting, for tractors, for inner roads, for the hacienda, for various aspects of the infrastructure, which the FOA takes care of. Instead of a property manager, we actually have a farm manager, third party, who actually does all the work. This is a very passive investment, just like a turnkey single family rental. And here's the key to my entire farmland journey with Keke. We had to work out how to invest in this asset class because there is no rule book. In US residential real estate, it is spreadsheet driven. It is data driven. You can find out by the macro MSA, 400 of them across the US, whether there's job growth and condo values are going up, whether crime rates are coming down. You can work it down to the zip code, down to the block in the US of what those statistics are. You can work out how much a 2-bedroom, 1,200 square foot in Cincinnati, Ohio rents for. There is none of this data in farming. So we built this matrix having lost 300 grand from working with crappy providers who were promising the earth but didn't have a clue. And so we built this matrix so we could go down and detailed due diligence. So the crop, what's the market demand, growth cycles, harvest cycles, what diseases do those crops suffer from, sales, product availability, what's the supply volume, which countries around the world produce it, to what markets, what's the consistency of supply during which months of the year, based on the regions being grown from. sales channel? Where are the middlemen in this area? What is the product pricing? Is it commodity? Are there regular spot prices? What's the wholesale price versus the commercial price in different markets? Processing, distribution, logistics, customs and trade, use of technology, route complexity. Does stuff get held up at borders and customs? Farming, there's certifications, global GAP certified, there's food safety protocols and pack houses, transport and shelf life window. Coconuts are very versatile. You can keep those around for several months. Limes, you've got 30 days to get them overseas and get them sold. Different fruits and vegetables have different transport and shelf life capabilities. From an investment standpoint, location, political, economic, currency, environmental, weather, water, soils. Is there enough water? Are you buying a farm in California? You're going to get screwed over the next 10 years. Entity structure, what's the jurisdiction of the investment, the banking system, ownership structure. Can you have, foreign ownership property rights to titled farmland overseas in certain countries? You can in some countries, you can't in others. Financials, the full model review, what you do normally. Is there a capital buffer? What are the returns and projections? What's the sensitivity analysis? Team, what's their track record? All aspects of selling and distributing fruit. Quality and depth, language, culture, location. You will get ripped off if you are gringo in Mexico trying to do farming. So you need local Mexicans or Chileans or Colombians or wherever you are to run those farms and run the business for you. Communication style, are they giving you regular updates on your ownership and how do they do that? Number 9 is field operations or farming. Are they multi-generational farmers? What's their crop and region knowledge? What's their history? How do they use technology, ag tech in farming? It's an incredibly, like every other aspect on the planet right now, the use of technology is accelerating and making efficient agricultural business. And then a bunch of intangibles, demographic trends. Are people still going to keep, using limes? Absolutely. Coconuts? Absolutely. Coconuts are across, coconut water, beauty products. I mean, you name it. Incredibly versatile product. Avocados. Haas can't source enough Haas avocados for global demand. It's a hockey stick of upward for the past 20 years. And just prior relationship investment team, who what their background has been, who they've worked with, who's in the network. So we actually had to build this and construct it. We lost a bunch of money making bets with people who didn't know other stuff. We've ended up with Farmfolio because they knew all this stuff and they have held water through all these risk aspects. So I'm going to pause there because I want it to be interactive. I want your questions. We are basically a combination of our journey, experience and everything, and really, things might change. We're all making it up as we go along in our life journey. We think we've settled into asset classes that we now can appreciate and can provide long-term wealth for us and our family, and we're really here to share the message and try and help people do the same. So anything I've missed on that last bit?
I don't think so.
So please ask questions and how can we help?
I have questions.
Please.
All right. So thank you. I mean, it's super informative. I've never even thought about farm investing in my life, but I'm pretty familiar at this point with real estate investing. So a lot of my questions kind of come from that angle, where I'm thinking about real estate and I'm wondering about more from a financial profile, how that compares to the farmland stuff. So it sounds to me, and tell me if I'm wrong, it sounds to me that basically the farmland investing, it's got probably a higher yield, but is there any sort of appreciation play there, or is there any sort of way to generate? What I like about real estate is that it cash flows, but you can go from like here to here over a certain amount of time. Hopefully the markets and cap rates are moving in your direction, but you can control it with NOI and other things. Is there any sort of appreciation aspects like that to farmland?
Yeah, so let me explain, and I added a few kind of slides in here in case I got a few questions.
You anticipated it.
I did. So thank you for being a straight man on this one. Slide's a bit broken, but you have to model the production of a tree in this case.
Yeah,
So
a perpetuity.
exactly. And so obviously in the first 2 years, you get no harvest. Third year, and this is a lime tree model, by the way, and this is kilograms of limes per tree per year, conservative model, medium, and optimistic. And you don't quite know unless you have a really strong team where you're going to fit in this curve. If you're bringing a new variety into a different country or location with different weather, soil, moisture, etc. So it is as much art as science, but suffice to see your appreciation curve is coming from the years 3 through 7. Because look at that. This is like, so the La Frontera is a farm. It has an average age of 2.1 years across 22,542 trees. And as the production of the fruit increases, the NOI increases, and that relates to the value of the actual lot itself. So think about this in real estate terms, because it is real estate. You don't have to be accredited to own this plot of land because you're buying title to a piece of land. Anybody can buy a piece of land. But the key to this thing is, when you think about it, is that you can buy this now, hold it for 5 years, average age of 2.1, you'll be at max production of those trees. I'll be producing 18 to 20% a year in this particular farm. 18 to 20%, you could then sell that lot to somebody else at a compressed cap rate of 8 to 10%. Because if you can turn to somebody and say, hey, you know what? I've got this farm lot. It's producing this cash flow for the last 5 years consistently. Fruits being sold to Walmart, Trader Joe's, etc. You know, I will sell you this land for 10 or 8% return. People will take your arm off for that compared to, frankly, 1.72% 10-year Treasury bill. So that's your combination of NOI increasing, cash flow increasing, therefore appreciating, and then you can compress the cap rate back down to then appreciate even more. Does that make sense?
Yeah. How my next question, though, directly tied to that is like how liquid is something like that? And by that I mean is what is the availability of buyers out there? Like, if you want to sell today, is there demand? Is there a market, or is there demand from other people who might not?
I mean, ironically, we are offering primary market farms right now. We're in the early stages. We can't get people to sell them because they're now sitting on them for the appreciation.
Right.
But we have enough people buying primary market farms that I believe those who want more of a track record, a lower risk, higher produce, higher income, when the time comes and people start to offer them up, we'll have the same people buying secondary market farms. So as part of our platform, we're actually, I mean, our dream is that 5 years from now, we have an ag platform where you don't just go to our website and read the brochure and then call a salesperson. You can actually go online, click through, select anybody's lot they're selling, do a straight through transaction and buy it, and contracts get exchanged electronically. That's our goal as a company, because we want, to democratize ownership of this farmland. And I have this image that, like, it's like Robin Ag. You have the millennials on their little mobile phone with this hockey stick curve and like, oh, put $100. I'd love people to put $1,000 in a set of farms and fractionalize ownership and that. So I think this is the next, let's say, foray into an asset class, is to make it efficient for ownership over time.
Got it. I've got one more question, if that's all right.
Oh man, Marshall, bringing it. Go
I
ahead.
know.
They're good questions. You hit 2 of mine already, so go ahead.
I'm hogging. Oh yeah, is that right?
Yeah.
Just knocking them off, huh? So I'm going to ask Greg's third question for him, and that is, so it looked like in your slide that you guys are partnered only with Valley Verde. Do you guys work with other packers and distributors, or is there some sort of is there any concentration risk going on with that?
There absolutely is, but there's also so the way to think about this, there's kind of 3 aspects to the end-to-end farmland business. There's the farming and growing of the produce. There's the middle bit, which is receiving it, packing, sorting, and exporting. And there's the actual sales and distribution for that final mile to supermarkets or wholesalers. In reality, we as Farmfolio are offering the service of packing plus selling. That's our core competency. The fact that we administer farms and have third-party farm managers who know how to farm under the FOA structure for the lot owners is by the by. You can always, if you wish, take your fruit to somebody else to sell it. So what we do is we want the opportunity, and the contracts are structured. When you buy your lot, you have a 3-year lock-in. You can give us a chance at Farmfolio for 3 years of selling and buying your fruit, buying it off you and selling it to somebody else. If we don't perform, after 3 years, lockup expires, take it elsewhere. We want to earn the business. And really, that's so to your point, you could take it elsewhere. Our hope is that we have such strong retail contracts, because once you're in that Walmart supply chain, once you're in Costco supply chain, it's incredibly hard to get in. It's incredibly sticky. And as long as you keep producing the best quality limes through a 12-month period, and so there's, I mean, I'm kind of going all over the place because I know so much about this now. So like Colombia's classic. Mexico and Brazil supply most of the limes and avocados and those kind of commodity fruits, but they can only grow massive quantities in the summer. July through August, September, spot price collapses in those markets. In Colombia, most of our farms are 1,100 meters high. They're all over regions. There's different climates. We can produce a steady supply of fruit 12 months a year. That's what the retailers want. And so we have fixed price fruit contracts, which avoid the spot markets altogether.
They're year-long contracts?
Yeah, yeah. And the way these are renegotiated at the end of every year is they look at the spot price, take an average for the whole 12 months, and then they negotiate back to us on that average price for the whole year. And because we're in Latin America, land is cheaper, labor's cheaper, it's cheap to export. We're not going over the Panama Canal, so we're avoiding all those costs of Panama Canal. We go straight up from the northern border of Colombia straight to the East Coast or Texas or wherever you want to go. And therefore, there's enough arbitrage in that end-to-end chain that we can make very good returns. US farmland, to answer a question may come, is that, you know, why are you in the US? Well, US farmland right now in this model makes between 2 and 5% if you're lucky. Because the land's expensive, the labor's very expensive. It's just a whole different ballgame. The key is to do it right overseas where the land and labor is cheaper, and export to a high price market where they're used to paying US prices.
One more. Is there any risk right now with like with everything that's going on with supply chains in terms of getting your fruit to where you want to get it to?
It's actually improving because nearshoring or friendshoring is becoming a thing. So think about this, you know, people were receiving exports from all over the world. We have very short journey from Colombia by ship into Philadelphia, 5 days. So it's you know, I know of some people who have been shipping into Long Beach who have struggled, in all honesty, because there's hundreds of ships sat outside that port trying to offload. Right. We have not had that issue. So maybe, Marshall, it's more, you got to be good and lucky. Maybe we were lucky that we ended up going to the East Coast, you know, to sell our fruit.
I had the question, what if a deer eats all my trees? And what I mean by that is, you know, clearly the returns are not specific to the yield of the individual trees you own. It's an aggregate of the performance of the farm as a whole. Maybe you can speak to that a little bit. So, you know, kind of related, is the individual ownership of the lots a function of the exit for the investors, just to simplify, you know, increasing the liquidity of being able to get in and out should you choose to?
Yeah, so to answer your question, really, your title, it doesn't matter where your lot is. because you're getting 1/103rd of the income minus the expenses. It's a great equalizer. Internet connection unstable. Can you still hear us?
Yeah.
Okay. We were in a previous investment where we had our own hectares in a farm in Panama. And the guy was like, oh yeah, we're going to tag your fruit and sell your fruit and give you money just for your fruit. It's, what an idiot. We believe the story. What do we know, you know? This was like 7 years ago before this journey started. And we're like, oh yeah, that sounds like a great idea. Every piece of land is different. You've got rocky areas, you've got hills. I mean, these are the best farms are hilly because it allows the rainwater to sweep down the hills. And, you know, farming should not be flat. We're not selling, you know, corn here, you know? So the best thing is when the rain comes down, it goes down the, you know, ebbs away. And anyway, I can go on for hours about this, but we, on our plot of land, basically had less trees. Some people's, you know, lots didn't take in Panama. Some people's did. Some people got nothing.
But in this model, in Farmfolio,
Yeah.
that's why they've laid it out where if there's 103 lots, you have 1/103rd of
The
that
entire farm.
revenue and expenses. So the pro rata.
So we
share of that.
designed it this way because of our past experience of getting screwed by that individual farm lot
And
model.
And then also, like, if there is a disease or something on the crops, one person's lot doesn't get like completely at risk penalized for that. I mean, obviously you can't control it. And what if it spreads from somebody else's lot onto yours? And so that's why, I mean, it just makes so much more sense to smooth the revenue across it. And then when you buy title, you're buying your piece of land, your trees, and the revenue associated with your ownership in that farm owners association. So that's all what's passing with title, right? The rights to that future income.
But really, the farms were meant to be operated at scale. And one of the things we're trying to do here is that you could buy into a syndication model of a farm, but you wouldn't control how long you had that income for. And so the FOA structure is designed to help with that. You know, you have title to a piece of land, but then you have a portion of the overall farm efficiency and profitability. So it was a good in-between model we designed really together to make sure we could democratize and let people get in for like, you know, $30,000 versus needing to spend $3 million on a farm.
Yeah, and kind of the other thought, and you know, your due diligence spreadsheet there really kind of mapped that all out, is the, you know, the risk profile that this is, you know, it's a little bit more risky for any number of reasons. And hopefully, you know, that is reflected in the returns that you would expect. So, but you know, the regulatory risk was the first thing that came to mind. But, you know, to put it in perspective, how much of our stuff is already coming from Colombia and we don't even think about it?
Yeah, right.
Yeah,
Because I know my bananas don't come from, they're from Ecuador or something.
I mean,
and they seem to have been there for the past 30 years every time I wanted a banana. So
it's amazing. Come down to some Latin American countries and see the amount of agriculture which is supplying all of our local markets here. It's been,
yeah, I think it's just the window when you start thinking of it as an investment. It's like, oh wow, how could they do that? Well, we've been buying it for decades.
Yeah, exactly.
You can fly in Colombia from Apartado down to Manizales, 4 hours, and all you see is banana trees. It's insane, the scale.
Mm-hmm. And coffee, right?
Yeah.
Most of our coffee, a ton of our coffee is coming from Colombia.
Yeah, so we just don't realize it's always been there. We're just finding a way to make this an agricultural ownership instrument that can give you income now.
Yeah, it's super interesting. I mean, we're coming up on about an hour. I want to be mindful of everybody's time. How do we find out more information, Peter and Keke? Is that something you can drop in the chat, or you've got it there? People can screenshot.
I mean, so my company is farmfolio.net. It's all right.
And this, you know, we'll add this to what, the YouTube channel?
It'll go to
Kim?
YouTube, yep. Probably be a podcast as well.
Oh, okay. So we'll put it out in a couple of different ways over the
Yeah, and
next
part of it's
couple of
all-
weeks or
yeah.
something.
And part of this also, again, we appreciate Darren, Greg, and Kim for allowing us to present today, but we're also pushing the fact that our stable wealth is for multifamily. 75%. Just the diversification of farmland gives us that other 25%. So we're all about helping people invest in multifamily and farmland the right way. So, globalinvestoralliance.com is our kind of education portal. If we can help people, we're all ears to help you avoid the mistakes that we've had early in our journey. Sorry, the dog's whining. What are the average year returns? 1 second. I'll give an example farm. So obviously, because the trees are young, we recommend a minimum 4 years hold. And once you get to this point, you start to see when the trees are 5 years and above, you start to see these, serious returns start to arrive. And so you'll see annualized rate of return hitting the 19-22% in years 6 through 10 of holding that lot. And to Marshall's question earlier, the lot you buy is 32 grand. As we catch up to the full harvest, you'll see the appreciation of that lot start to double over that time period. And that's when you kind of back into, the double stars there is selling that land at a 9% cap rate in this case. So it's compelling, a different risk profile. We meet people who like Americans say, oh, I don't want to invest overseas. Well, we're an American company. All of the fruit's being sold to American companies, Canadian companies. Yes, there's risk in farming, but we make sure we have some of the best farming teams in South America to do that. So Julie's given us a nice painting. Thank you, Julie.
Yeah, I appreciate you sharing, you have that allocation of whatever it was, 84% of your portfolio to real estate for kind of breaking up how you allocate within that very large bucket. It's always interesting to see what people's point of view is on that, and that, people, I invest in real estate, like, well, don't put all your eggs in one basket. Well, there's lots of baskets within real estate. So you just got to dig another level deeper to see how you can diversify within an asset class. But
Looks like there's one more question.
Oh, all right. Are you only allowed to buy one lot? No, you can buy them. Marty, how many lots you want, bro?
Here's what people do. They basically back into their passive income monthly number. And so you can kind of, we have a spreadsheet which we let people look at, and actually they put in their allocation in stocks and in ETFs, mutual funds, and real estate, gold, and we let them do the allocation. We actually let them move it around, and they can see the portfolio returns based upon 10-year averages. So yes, absolutely. Think of it as an asset allocation at the macro level. Know for each asset type what your broad range of returns from a cash and appreciation are, and then back into your preferred cash and appreciation numbers over a long term. That's what we help people do. Because unless you know what you're trying to aim for in life, where are you going to head? How are you going to make decisions?
And maybe one more common question: is this open to accredited investors, sophisticated investors? Does it matter?
Everybody in the world. This is your buying a
so that
piece of real estate.
Goes back to the democratization type thing that you talked about earlier. Yeah. Okay.
And my goal over the next 5 years is to fractionalize this down to the tree on the blockchain.
Oh, all right. I kind of thought you might be going there with it, the way you're.
So like you can buy people a goat for Christmas in Africa.
Mm-hmm.
You're going to see this one day where you can buy someone a tree.
Yeah, I mean, it makes perfect sense, honestly. So, all right. Well, thank you guys for joining us here on the virtual
see you
version
guys.
of the East Tennessee Multifamily Meetup. Federico, good to see you, man. Came in a little late. We won't hold it against you. You can listen to the recording. And everybody else, I think we're going to wrap it up. Peter, Keke, thanks again. Safe travels or not travels as it is for maybe the foreseeable future, and pat Cookie on the head for us.
Will do.
Definitely.
Thanks, Greg. Thanks,
Yeah.
James. Thanks everybody for your time
Yeah,
today.
thanks for
Appreciate it.
organizing it.
Thank
All right.
you.
Thank you. Everybody have a good night.
Thanks.
Bye-bye.
See you guys.
Talk to you later.